Imagine you're up 5 days in a row. You feel locked in. Then one trade goes against you, and it is not a normal loss. It gaps through your stop overnight. Your account is down 30% before you can even think. Now the real question shows up. Was your strategy bad, or was your position size reckless? I have watched more traders fail from sizing than from being wrong. Being wrong is normal. Markets are uncertain by design. Position sizing is the part that decides if you live long enough for your edge to show up. Edge means a small advantage in expected value, which is the average outcome over many trades. Even with an edge, you can still lose money for a while. That stretch is called drawdown, which is the drop from your peak account value to a later low. Drawdown is not just math, it is psychology. It changes how you behave. Most people think the game is prediction. I think the game is survival under uncertainty. Sustainable trading is less about the best entry, more about controlling the size of your mistakes and the speed at which a bad run can kill you. Look at LTCM in 1998. Long-term capital management had brilliant people and sophisticated models. Their problem was not that every idea was wrong. Their problem was leverage, which is borrowing to amplify returns. Leverage also amplifies losses. They held positions that looked diversified on paper until correlations went to 1. Correlation is how assets move together. In calm markets, some things zig while others zag. In stress, many things fall together. When that happened, their position sizes were too large for the liquidity available. Liquidity means how easily you can exit without moving the price. They could not get out without crushing themselves. That is position sizing meeting reality. Or take Barings and Nick Leeson. The story is often told as one rogue trader. I see it as a sizing and control failure. A single seat accumulated risk so large that one person could threaten a bank. That is not just a moral tale, it is a sizing tale. If your system allows one bet to become fatal, the system is broken. Sustainable trading needs limits that are boring, consistent, and enforced when you feel most confident. So what is position sizing really? It is deciding how much to risk on one idea given that you can be wrong, the market can gap, volatility can spike, and your own emotions can sabotage you. Volatility is how much price moves around, day to day. Tail risk is the chance of rare extreme moves that sit in the tails of the distribution. Those tails are where careers end. The first sizing mistake I see is using feelings instead of math. People size up after wins and size down after losses. That is called recency bias, which means your brain overweights what just happened. It feels logical because you feel confident after wins. But the market does not pay you for confidence. It pays you for being right enough, with small enough losses, for long enough. The second mistake is sizing from the entry, not from the exit. If you do not know where you are wrong, you do not know how much you can lose. Many traders say they will stop out if it goes against them. Then the market moves fast, spreads widen, and they freeze. So the real loss is not the planned loss, it is the emotional loss. Sustainable sizing assumes you are human. It builds in room for slippage, which is getting a worse fill than you expected, and it assumes some stops will fail in gaps. I think of sizing in 3 layers: account risk, trade risk, and portfolio risk. Account risk is how much of your total capital you can lose before your process breaks. Trade risk is the loss on one position if you are wrong. Portfolio risk is how positions interact, especially in stress. Account risk starts with a harsh truth. Big drawdowns are hard to come back from. A 50% loss needs a 100% gain to get back to even. That math creates desperation. Desperation creates overtrading. Overtrading creates more losses. This is how traders spiral. So I size to avoid the kind of drawdown that changes my personality. Trade risk is about defining a unit of pain you can tolerate repeatedly. Many professionals think in terms of R, which is 1 unit of risk. If I risk 1 R on a trade, I accept that loss as normal. The key is that 1 R is small enough that a string of losses does not end me. Losing streaks are not rare. Even a good strategy can lose 10 times in a row. If your win rate is 50%, 10 losses in a row is unlikely but not impossible. If your win rate is 35%, it is more likely. This is base rates. Base rates are the normal frequencies in the long run. You size for the base rate, not for the best case. There is a concept called risk of ruin. That is the probability you blow up or fall so low you cannot recover. It depends on your edge and your bet size. Bet too big and ruin approaches 1. Bet smaller and ruin drops. Sustainable trading is often just reducing risk of ruin until you can play long enough. Some people hear this and say, fine, I will use the Kelly criterion. Kelly is a formula that tells you the optimal fraction to bet to maximize long-run growth based on your edge and odds. The problem is that Kelly assumes you know your edge precisely. In real markets, your edge is uncertain and can decay. Regime shift means the environment changes, like going from low volatility to high volatility, or from trending to mean reverting. If you size at full Kelly and your edge is overestimated, you can get destroyed. Many serious traders use fractional Kelly, which means betting a smaller fraction than the formula suggests to reduce drawdowns and model error. Now let me ground this in something practical. Suppose you trade a setup with a small edge. You do not need to be right all the time. You need your average win to exceed your average loss after costs. Costs include commissions and slippage. If you risk too much per trade, variance will whip you around. Variance is how spread out outcomes are around the average. High variance with big position sizes is emotional chaos. Emotional chaos leads to bad decisions, like moving stops, doubling down, or revenge trading. I also want to talk about volatility-based sizing. If an asset moves a lot each day, a position of the same dollar size is riskier than a calmer asset. This is why pros often scale size inversely with volatility. In plain terms, I trade smaller when the market is wild, bigger when it is calm. This keeps my risk more stable. It is not perfect because volatility can jump, but it is better than pretending all markets behave the same. There is also concentration risk. Warren Buffett is famous for concentrated bets, but people miss the context. He concentrated when he believed he had a large margin of safety, which means a big buffer between price and value. He also had a long time horizon and permanent capital. Most traders do not. If you are trading leveraged products or you can get margin called, concentration is a different beast. Leverage plus concentration is how small mistakes become fatal. Charlie Munger talked about avoiding stupidity. In sizing terms, stupidity is taking a position that can end you. If one event can wipe you out, you are not investing. You are playing Russian roulette with better marketing. Jesse Livermore is a useful cautionary tale. He had periods of great success and periods of ruin. Part of that story is psychology, but part is sizing and leverage through cycles. When you are right, the market lets you feel like a genius. When the regime shifts, that same size becomes a weapon against you. George Soros is often linked to big macro bets. What gets lost is that big bets were paired with risk awareness. Soros talked about reflexivity, which means prices can change fundamentals, and fundamentals can change prices, creating feedback loops. In a reflexive market, moves can extend far past what seems rational. That is opportunity, but it is also danger. If you size too big, you cannot sit through the noise. You will get shaken out, or you will panic at the worst time. Paul Tudor Jones is known for focusing on defense. Defense is sizing so that you can take many shots. Stanley Druckenmiller has spoken publicly about pressing when conviction is high, but pressing is not the same as reckless. Pressing without a defined exit and a defined max loss is not pressing, it is hoping. Portfolio risk is where many traders get surprised. They think they have 5 positions, so they are diversified. But if all 5 are tech stocks or all 5 are long-risk assets, they are one trade. Diversification means holding things that do not all fail together. But correlations change. In 2008, many assets that seemed diversified fell together because the common factor was leverage and forced selling. So I think in factors. A factor is a common driver, like growth, rates, oil, or liquidity. If my positions share the same factor, I reduce size. I also respect gap risk. If you hold overnight, your stop is not guaranteed. Earnings, geopolitics, central banks, and simple thin liquidity can gap you through your level, so my size must assume a worse loss than planned. This is not pessimism, this is realism. Tail risk is not frequent, but it is decisive. Then there is the behavioral side. Loss aversion means losses hurt more than gains feel good. That pushes people to cut winners early and hold losers too long. Position sizing can reduce the emotional intensity so you can follow your plan. If your size is too big, your brain will invent reasons to avoid taking the loss. It will feel like self-protection. It is actually self-sabotage. One more subtle point. Sizing is not only about not losing, it is also about being able to exploit opportunity. If you are fully loaded all the time, you have no dry powder. Dry powder means uncommitted capital you can deploy when the odds improve. The best opportunities often show up when volatility is high and people are forced to sell. If your sizing kept you alive, you can act. If your sizing left you wounded, you will watch. I like to think of sustainable sizing as choosing a speed you can drive for a long trip, not a sprint. You can arrive fast once and crash, or you can arrive safely many times. The market does not care about your timeline. It will offer you randomness every day. Your job is to make sure randomness cannot take you out.